They're a shipping company, ocean transportation, dry bulk cargo worldwide. So these guys do the dry bulk. So they're not like containers with product from China that's manufactured. They're taking like loose product. Okay, these are different types of ships. Got it. I did really well with a company which was by the name of Panel, and I bought them when they were like 400 million in market cap. I think I tripled my money on it. So shipping companies can make us money, real good money. So these guys have up 9.6%, down 25.64. So interesting. So they're having a good year. Why are they having a good year? Is the shipping rates kind of causing, whoever companies or governments that are ordering this material, they're going to have to sail the material longer to avoid some of these tariffs, or I don't know. It's a tiny cap company, 1.93 billion. Revenue is 1.22 billion. So, okay. And that's kind of normal for shipping. Okay. That's just normal. Forward P is 9.42. Okay. That looks good, but it's kind of normal for shipping. Dividend is massive, 15.25. Wow, that looks good. 1 month. So they really got sold off over the 1 year. 5 year looks great. Yeah. I started buying Panel over here too. I sold somewhere around here. Okay, so these guys are sold off. Maybe it's an opportunity. So I'm going to check to see if they can afford the dividend. I'm going to also look at their fundamentals, their financials, just to see if the business is strong. So this is kind of a very cyclical business. They do well for a while, then they have a contraction year. Do well for a while. They did well for 1 year, began to contracted in 23, and then they're beginning to grow. Wow, they're really growing in the quarters. That looks really good. Why is the stock contracting so much when their revenue is so high? Interesting. They're going in opposite directions. If your revenue is expanding that much, your stock price should be going up. So you're seeing this pickup. So that's maybe the market is recognizing these guys are really doing well. Could be. It's the beginning of a rally, potentially. So revenue looks really good. It is cyclical, so you got to get in and get out. Okay. When you buy into shipping, there's two decisions you're making. I would suggest is you're deciding, okay, I'm going to buy, but I also need to know, when am I going to sell? If this, am I going to sell if it goes up 50%, if I double my money, and then I get out? Because these will come down, in my opinion. All right. So free cash flow looks good. 430 million free cash flow. This is a tiny cap. So that looks good. And gross margin looks good. Profit margin looks great. And when we look at free cash flow per share, $4.26. So high level. Yeah, they can afford the dividend. So dividend, they can afford it. Let me take a peek at their balance sheet. How much debt do they have? Not much. So they have about 1 billion net debt. Not bad. Debt to EBITDA 2.71. And they're cranking out nearly $500 million of free cash. So that looks good. This company looks strong. Looks good. This may be the beginning of a rally. This might be, the company gave up some of their stock price, and maybe it'll come back up to $35 a share. And it'll happen. It'll happen fast because this is a tiny cap. Based on their free cash flow, this business is worth, $3 to $4 billion based on free cash flow. So this one looks really good. I've been kind of keeping my eye on ZIM because I've made money on ZIM on 2 occasions, made money on Panel. So I've got a little bit of a hot streak in shipping. I think it's about time to get back into a shipping stock. So I'm going to put this guy. In fact, why don't we do this? Why don't we do a full valuation? We'll go head to head. StarBulk carriers against ZIM. They're two. So the trailing 12 months, it was 417 million. Now, do I want to grow that? These guys are cyclical, so let's be conservative. We're going to go zero growth. Just straight line it. If it does better, great. If it does a little worse, no big deal. Okay. So cash, they had 400 36 million to 4, and then debt they had. Okay. How many shares are outstanding? 117 million. So based on straight line cash flow and a very high discount, this stock's discounted by 10%. Now we look at the earnings per share. For 2025, it's expected that earnings per share is going to be $2.71. Growth rate, there is going to be a growth rate there, so we just go to 0. Yeah, the market isn't going to give them a 12. That's the best I could do there. So, this stock is it's valued more based on the cash flows it's going to produce. It'll produce a nice return. I mean, you have a very high discount, but the numbers with ZIM are even better. I mean, the cash flow here is just freaking amazing. It's amazing how much cash they produce. And this business is really strong. And then you have these tariffs, right? So you may end up with Canada needing to import more from other parts of the world because they don't want to import from the US because there's that 25% tariff, that tariff war. And although they put them on hold, the whole tariff war could really cause a lot of shipping charges. So that's one thing to consider. So I'm not going to give up on ZIM. I think I'm going to stay with ZIM. Here's the valuation. I'm going to take a screenshot of this and send it to you, Mike, on Discord, but then I'm going to delete it. But for me, I'm still going to buy into ZIM at the right time. And that's my evaluation of StarBulk carriers.